Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. Today, I'm going to cover Clorox Company, and I'm going to show it as a lesson in valuation, and more precisely, a lesson in overvaluation. Those of you who might have been following it know that it fell almost 10% yesterday in trading. And what's happened is we've gotten some strong guidance from the company, a lot lower than what was anticipated prior. And obviously that had an effect on the stock. But what I really want to do here also, in addition to just covering Clorox, I do a lot of videos where I cover multiple companies, 5 to 10 companies or even more in some cases. And the problem with that, which I think that's important because I think it helps give you, the subscriber that I care so much about, a good perspective on what stocks look like and what markets look like and so on and so forth. But I'm only doing a cursory review when I do that. I don't really get into the in-depth analysis that I think is required to really evaluate a company. So I'm going to kind of do that with Clorox today. And I'm also going to show how important it is for continuous research and due diligence, because a couple of days ago, as I'll illustrate here in a moment, Clorox looked a lot different than it does today. So let's go ahead and get into what I want to show you about Clorox and how I want to analyze a deep dive into Clorox, the company, and with an objective of determining whether or not the stock is attractive now after this recent sell-off. So what I did was, to give you a perspective, I took a screenshot of Clorox yesterday, okay, and I just put it in a simple Word document here. And you can see this is dated August 2nd, and this is what Clorox looked like. The price was $181.20. It was trading at a relatively high PE. It was offering an earnings yield of only 4%, but a dividend yield of 2.5%. Now, this is a dividend champion and a dividend aristocrat. Clorox has increased their dividend for 44 consecutive years. That's critically important. I love dividend aristocrats and champions. And one of the things about that is this is the kind of company that I really like to talk about. I really like to do videos on. I really like to analyze and evaluate. But I've been very frustrated with the high level of the market here because, as you can see, it's been for the last several years here, going back to fiscal year 2015 and even 14, where the stock has been significantly overvalued. Coming out of the Great Recession, it was reasonably valued, all right? But the point I want to make is the pandemic, obviously Clorox with all its disinfectant products became a hot stock. And so the price went up dramatically, and now we've had a correction. Yesterday it was down 10%. But what I really want to focus on before I get into the live fast graphs for Clorox is I want you to notice what the earnings estimates looked like yesterday. In the fiscal year ending June of 2020, the company earned $7.36. They were forecast to earn $7.60 this year, which would have been a relatively modest 3% increase, but an increase nevertheless. And then longer term forecasts for next year, fiscal year 2022, were $7.53 and out to $7.87. So let's go ahead and now move into the live version of Fast Graphs. And I want you to see in one day how much things have changed. And this is why comprehensive research and due diligence is so important. So now, we still have the $7.36, obviously, because that was an actual number for the June, period. But now we're looking at the actual for June of 2021 that didn't come in at $7.60. It actually came in as a negative growth rate at $7.25, and they just reported that yesterday. Okay, and now the forecast based on guidance, and I'll show you a little more about that later, is for $5.65 for 6/22, which is a 22% drop in what we saw, in the previous screenshot that I showed you that I took yesterday. And then we're looking at a pretty strong recovery, if you will, to 683, a 21% increase, but a number that still will be lower than what analysts were expecting just a few, short while ago. Now, I also want you to note that we've had this significant drop. We had a 10%, roughly, I think it closed down 9.7 or 8% yesterday. But I also want you to notice that not only did the price drop yesterday, the earnings estimate dropped dramatically yesterday. And so everything has changed. All right, this is not the same picture that you saw just a day ago. And again, this speaks to the absolute importance of continuous research and due diligence. If you're investing in stocks, there is no substitute, first of all, for research and due diligence. And you got to be constantly watching all your companies. That's one reason why I like relatively concentrated portfolios. I like to see portfolios, where the investor has maybe 20 to 25 stocks, 30 tops, because they need to be able to keep up with what's happening, because here's a radical departure in just a day. Now, our new version of Fast Graphs, as you know, is coming, but it's not working yet. But I do have it live here today because it's not updated yet for today. That's one thing. This isn't ready for prime time yet. But again, I did want you to see the difference. This is using weekly closing stock prices, which will be an upgrade from what we currently do. But you can see what the price looked like and what the stock looked like yesterday through yesterday's close on the new version of Fast Graphs versus what it looks like today. We've seen this significant drop. Now, when you go into the forecasting calculators, you're going to see this reflected in the calculators now. Okay, and this is a very important aspect of utilizing the tool correctly and trying to ascertain. And I want to go over some of this, to how to use the forecasting calculator correctly, because you're not buying the past, you're buying the future, always. You're always investing in the future. So what's really important is what kind of an estimate, what kind of forecast you can possibly make about what the future might hold for you, because that's where you're going to either make or lose your money going forward. Okay, so there's a couple of factors here that I want to show you. So this would be a normal PE of, using the Graham-Dodd formula, of about 13, okay? The actual normal PE for this company, or this would be a calculated intrinsic value PE based on a low growth rate of about 2.37%. You run it through the Graham-Dodd formula and you get a fair value PE of 13. Okay, now having said that, the normal multiple for Clorox has been something entirely different. One of the things we have in the normal multiple calculator, now I want you to notice I've got the same earnings numbers here, because both of these forecasting calculators are based on the same analyst making the same estimates. What's different is what multiple we apply to what the future might look like. Okay, now here's where using the forecast gets a little iffy. Okay, the current blended PE, even after yesterday's drop in close in price, is 23.1. Okay, that's, relatively consistent. But when I go looking at the normal multiple, I have a drop down here that allows me to evaluate what PE ratio the market has typically applied to this stock historically. And you can see that it's been, above 20 in every single historical time period going back over the last 20 years. Okay, so the lowest multiple has been 20.68. Now I can click on that, and that changes this to 20.68, and that changes my perspective. So this would be kind of like the lowest normal PE that the market, applied. Now, the tool automatically defaults to the 5-year normal PE, the most recent 5-year PE, which I could calculate by scrolling out here and then drawing this as a 5-year graph. But I'll bore you the time it takes to do that. We've already done that calculation here in the dropdown. Okay, so this would be, an opportunity for me to make some what-if decisions. Okay, so, I'm going to be a mid-case. I don't want to say it's going to be as high as 25, which is one of the highest PEs. 27 was the 1-year PE that it was trading at before the earnings correction. But, if I pick the 20 PE and one of the lower 20 PEs, all of a sudden now the stock looks reasonably, it looks like it's still in the fair value range, but because of the drop in earnings, we don't see much in the way of return potential. In fact, we see very weak return potential. The only real benefit of owning the stock at this point would be the dividend. And remember, this company's increased their dividend for 44 consecutive years. Now, this is kind of maybe what I would call a conservative case. I could then go ahead and apply maybe as close, I'll use 24.97 here. That's kind of the 25-ish PE ratio that we see happening a lot. And certainly there's a story to be told here, because you're seeing that higher PE ratio more recently. The PEs were higher than the 20 to 21, which I would consider to be more normal, because you see that clearly, because you see the prices. Here's the 20.77 historical long-term PE, the blue line on the historical graph using the all-time frame, and you can see that the price has been above that for the last several years. All right, so that helps me understand that my normal PEs here in recent years have been, I'm going to say, abnormally high. Okay, so, I might want to stick with a 20 PE if I'm going to make a decision. Now, what does that mean? That means I'm not ready to buy this stock yet. Okay, and yet it's one of my favorite for dividend growth portfolios, okay? Because when I look at the long-term historical performance of Clorox, now, before I do that, let me make a point. The stock was modestly overvalued back here. It was trading at a 25 PE, which is even higher than its 20.1. Okay, so I'm always, I always like to say measuring performance without simultaneously measuring valuation is a job half done. So this is, kind of a high PE, but it's very close to what the PE is now, just a little bit higher than the 23.1. Okay, and I had a 6% growth rate over this time frame. So when I look at the performance, I get to see that I had 7.7% capital appreciation, which is consistent with historical growth. I had a tremendous dividend record. Okay, it threw off $13,197 of dividends on a $10,000 investment made in December of 2000. And it was, I'll say it's close to 3 times more than what you'd have got from the S&P, but it also produced more capital appreciation than the S&P. And this was a pretty good period for the S&P, although in all fairness, back to my measuring valuation, the S&P was a lot more overvalued here than Clorox was. Okay. Now, as we came through, it tracked a 20 multiple, 20.7 multiple. It's always, these numbers are always ish, and you should always be thinking of them as ish. At the 20th multiple, because this is a valuation reference line. I'm looking at it to analyze what I'm seeing here. But then the recession reset it down to where it became really, a fair value relative to most companies with 6% growth rates. This one has been continuously and almost chronically given a premium valuation with the market. Now, a lot of that probably has to do with the brand. It's an A- rated company, but I also might point out that the company does carry a lot of debt. But the key point I'm trying to get across here is this stock, in the hype of the COVID and all the cleanliness, the sanitizing everything, people using wipes and hand sanitizers and so on, you can see this is a classic case of the short-term market being a voting machine. People got excited about the opportunity they saw with COVID, and it actually did have a good earnings year. Keep in mind, a 16% increase in earnings, but nevertheless, the stock price rose to PE ratios that were unprecedented even in this company's history. PE got up to 30 in July of 2021. The blended PE was actually 32.18. Now, since that time, now with the drop we had yesterday, the stock has fallen 30%, but it fell 10% in one day yesterday. 9.7 might be the actual number. But this is a function of overvaluation, and this is a case where the overvaluation, although it had been kind of chronic for the last 4 years, it kind of got really extreme, in the last year during the pandemic, if you will, or as a result of the pandemic. And now we're starting to get a couple of things happening. Number one is, we've had this correction where the stock was already moving back into alignment. Keep in mind, that was through here before. You going back to this new graph, that was where the stock was still trading at a very high, almost a 25 PE, as of the July 30th close. So the stock was expensive, but it was starting to come into line. But now we've got the lines moving, the earnings are moving, the earnings are falling and dropping. And that changes the landscape dramatically as far as what valuation looks like, because now we're looking at, forecasting numbers where we're expected to have a bad year. So the point is there could still be more bad news to come. We don't know that yet. What we know is what just happened. We did make $7.25. This is still showing as an estimate on the fast graph, but that is the actual number, as I'll show you in a moment, the actual earnings number that they made for the fiscal year, June 30th, 2021. Okay, but here's the big key, and this is what I really want you to see. 6 months ago, analysts thought earnings were going to be $8.16 for this fiscal year. That was for the next fiscal year, June of 2022. That was a very optimistic. They expected $8.09 for this fiscal year, which just ended. And 3 months ago, it even got more aggressive to $8.29. Then it dropped to $7.60, which was on the previous screenshot I showed you that I took on the Word document. And then it ended up at $7.25. Next year's forecast 6 months ago was $8.16. It dropped to $7.61, and now it's $5.65, and that's on the high end, I might add, of guidance. I think guidance, I'll show you here in a minute, is like $5.45 to $5.70. That's company guidance, what the company's telling the analysts, and fast graphs, the consensus is giving, I guess, the benefit of the doubt and giving it on the high side of guidance at $5.65. But again, even at a 20 multiple or a 21 multiple, that's a negative rate of return for this this year. Even if I go all the way up to the 25 multiple, which I'm picking right here on the side of the graph, that would still be a negative 12%. So, even if the stock trades at the premium valuation it's always traded at, I still don't have a very good rate of return. Now, those are the negatives. The positives are my dividend yield is now 2.83% because the price has dropped. So I'm getting almost a 3% yield. Remember, the company's raised their dividend for 44 years. So if income was your pure goal, you could still maybe even start building a position because technically, these are forecasts, and as we've already seen, they can change very dramatically. Now, when I look at the analyst scorecard of this company, though, I do want you to note that they've had a very, very good scorecard historically. We don't have the new number in here yet. But the point is, if I look at the summary here, analysts get this company right most of the time. So that's something that I can at least, think about from the standpoint of, are these numbers going to be reasonable? But keep in mind, I'm also getting this from strong company guidance. These numbers are heavily influenced by the guidance that the company has offered. Okay. Now, I want to show you something else about the forecasting calculators. Everything is mathematically driven here. This 2.37%, you should always be looking at the numbers, okay, that you're seeing, because they calculate correctly because you've got a -1, a -22, a 21, a 7, and an 8. Okay, but here's the key. The next year's forecast is to be, 22%, and then in 23 it's to be 21, 7, and 8. Okay, now the long-term forecast, if I go to the 3 to 5 year forecast, we're not really getting one. They're basically saying it's not available. But if I go to an external link like Yahoo Estimates, for example, where I can look at the estimates for Clorox and look at the next 5 years, these guys are saying 3.25%. All right. Now, different set of analysts, but it's still a relatively weak number. So I could go into the custom calculator. Okay, and I can go down here and I can put, I'm going to give them the benefit of doubt, and I'm going to say 4%, and I'm going to draw the estimate at 4%. Okay, now I've got, PE ratios here. I could just leave it like this and just look at my table here and say, okay, there's a 21 PE, and that's what my return would be if it, did grow at, say, 4% going forward long term, and I got this level of earnings. This could still be a 6% rate of return, which is going to be predominantly from the dividend income, I might add. Okay, capital appreciation, would be 24% roughly from today. It's forecasting a price of $203.38 from the 164. So you can do the math on that, but you're also looking at getting $30 in dividends for a total gain of just under $70. And that comes out to an annualized rate of return of 6.18%. So the point is, I'm utilizing the numbers here that make sense. Now, I could even be more aggressive, and I could go back to this more normal multiple estimate tab, and I could just take these numbers. I could ignore 2022, call this a given that's going to be down, and I could add these numbers up. These are different ways you can use the charts. These are calculators. Okay, this is designed to allow you to do what-if calculations. So what if it did grow at 21, 7, and 8? Okay, so that's, if I add those numbers up, these three numbers here, 21, 7, and 8, I get 36. Divide that by 3, I get 12% growth. That would be 12% growth from this number here. Okay, that would change the landscape. I could go into the custom calculator. All right, I can run those numbers and put it in. I'm not going to bore you for going through that. My point is, I can come up with different scenarios. Okay, another thing I can do then, rather than do that, I can go into historical compound annual growth rate calculator, and I could then find, growth rates, historical growth rates that have been normal for this company. And again, it's had good growth here recently that is skewed by the COVID numbers. So 6 or 7% looks like a pretty good number to me. So I go ahead and I do the 7% on the using here, instead of using analyst estimates, I'm simply using historical results, that the company's been able to achieve consistently, because it is, if you recall, going back at the stock, it's been a very consistent performer with the exception of what's happening now. But again, this is, part of this has to do, there's a lot of reasons for this, which we'll get into here in a minute. I don't want to digress. But the point I'm getting at is by going in here into the forecasting calculator, I can use this. If I apply like a 20 PE, I get a double-digit rate of return. So there are possibilities that this stock would be reasonably priced at today's levels, okay? So then before I go on, let me look at it from a different perspective than just earnings, because this is a high dividend paying stock. So I do like to go in and I like to look at operating cash flow. Now, as I'm doing that, I could look at diluted earnings, I could look at basic earnings, I could look at other earnings metrics, but I want to look at cash flows. And you can see the cash flows do explain a lot of this spike in price that we saw here, but now cash flows are expected to kind of revert back to the norm. If you really connect these two dots, you can kind of see that, what's really happening here is it's getting back to a more normal rate of cash flow. One reason this company's been able to pay their dividend, you can see that, their cash flow payout ratio has been about 35 to 50%, in that range historically most of the time. All right. In fact, if I go to the performance tab here and look at dividend cash flow, you can see that, it's been in the 40-50% range, especially in recent years here. So I'm analyzing all these things as I go through. But like I always like to say when I'm looking at dividend paying stocks, especially, and this is a member of Dividend Aristocrat and Champion, I want to look at free cash flow. Now, historically, the company has covered their dividend with free cash flow. I don't really care about price here too much. I don't care about normal valuations. What I'm really looking at is, does free cash flow cover the dividend? Now, it's possible that we could get negative free cash flow relative to the dividend, in fiscal 2022, which ends in June. But analysts are relatively sanguine. They think the cash flow, will increase, pretty dramatically right after that. So we're going to get back into some, good cash flow growth. So I still feel pretty good about the company's cash flows, and I'll get more into that. The company's doing some things that we'll talk about. Okay, so here I've gone through the company and I've put it through all its paces. I might go ahead and look at things like EBITDA, which is, again, another cash flow oriented metric. And I'm looking to see, I do like to use EBITDA as a valuation metric as well. This, again, tells the valuation story. This is simply the normal price to EBITDA over this 20 years. You can see the last several years it's been on the high side, but even on that basis, it's still on the high side. By the way, in the new version of FastGraph, we will be adding, one metric we'll be adding is a price to sales, and we can see that this company normally trades at about 2.3 times sales. And right now it's currently trading at 3 times sales, which is, this was as of yesterday's price. So it's probably getting closer now. It's down another, 10% from here. So it's maybe getting closer to trading at a reasonable price to sales level. My point is, I don't look at one valuation metric. I also use the dividend yield methodology. Okay, you can see that the dividend yields historically are always highest when the valuation is lowest, regardless of what metric I use. And right now, as of last year, the dividend yield ended the year at 2.47. It's now at 2.83, so it's a little higher. And that, a 2.83 dividend yield, there's 2.66. There's 2.99. Those are times when the stock is getting more reasonably priced. So that's another valuation reference, if you will. Now, other things that I do is, one thing I do, I go to my external links then, and the first thing I like to do is go into the company's website. Now, I've already done that. So here we're going into Clorox Company's website. And within this, I can look at the company, I can look at their brands. Here's their new CEO, Linda Rendell. She gives a report here. You can log into that. But then what I also do, I like to go into investor presentations, okay? Now, when you go into investor presentations, this was the most recent quarterly, the fiscal year fourth quarter 2021 investor deck here. Now, I've already gone to the end of this for you because I wanted you to see this number. There's the 725 that they reported that ended in June. Obviously, there's the 725 that you saw on the fast graphs. There's the 736 that earned last year. So these numbers are consistent. This is as adjusted non-GAAP. Okay, that's the number, just to be clear, that's the number that we use in fast graphs when we're utilizing the adjusted operating earnings. This is the non-GAAP number that they're, giving us right there. Okay, so that's the 736 and then the 725, and I can shorten this for you a little bit so you can see it a little better. There's the 736 and then the 725 that we have currently. And then, of course, the estimates for next year, the 565. Now, when I go through this and go through this deck, I will get estimates for next year. So here's the adjusted earnings per share outlook. And they're saying the as estimated GAAP 505, adjusted, they're saying 540 on the low side to 570 on the high side. Let me go ahead and open that up. Okay, so that's what guidance, that's what the company is telling the analysts and so on that are currently looking at the stock. So you have 540 to 570. What we've got on the fast graph is 565, which, as I said earlier, kind of on the high side of guidance, but it's at least for currently a respected number. Okay, now in this slide deck, there's a lot of other things I can look at. I can go through here, and I'm not going to bore you now, but I can go through all the propaganda, if you will, that the company is telling me. I can look at their various brands. I will spend some time on this if I was interested. Right now, I still feel the stock is a little bit out of my price range, but I can learn a great deal about the company by doing this. The other things that I will do before I'm done, if I'm actually conducting research on the company, I will start going to other websites. I will do things like I'm a subscriber to Morningstar. I will go into Morningstar and I will, read the analyst reports on Morningstar. This is how you value a company. I'm going to learn about research. I'll go into sites like Zacks that has, talked about what they believe is going to happen. And, this is giving me more insights into what other leading analysts and other analysts, professional analysts, are thinking about the company. I would also go to places like the Wall Street Journal, directly from my fast graph tool here. And I would look for, any news items or whatever you might have. I might look for articles in places like Barron's and Forbes, which I can also get, from going through the various research reports. But now I'm really beginning to dig into the company. And then last but not least, I'll go into fund graphs, the financial underlying numbers here, and I'll start looking at the financials of the company. I like to start with the in millions graph, or what we call the gross graph. And I like to look at things like, I like to start with the balance sheet. All right, that's, one of the easy. And so, I'm going to look at things like common equity or book value. I'm going to look at cash and cash equivalents. And the company does have, a lot of cash as of the June 2020, and they've still maintained pretty high cash rates. This is through March of 2021. I don't have the most recent quarter yet, but it'll come through pretty soon. I can then look at debt, cash relative to debt. And I can look at long-term debt versus total debt. Those are important. That's on a quarterly basis. This is on a yearly basis. The company does have a lot of debt. I can also then look at cash flows relative to the debt. Does the company have the cash flow? That's the dark blue item here to amortize their debt. And the company obviously is a very strong cash flow producer, as I said. I will also go into things, and I would look at things like, different other valuation ratios I can look at. I already showed you price to book and price to sales, enterprise value to EBITDA I would look at. And, they're trading on the high side of that right now. That was through the March quarter. That's when the price was so high that I showed you earlier. I will go into the percentage graph. I like to look at gross and net margins. By the way, in the new Value U Academy that we're going to be launching videos here pretty soon in conjunction with the launch of our new product, we'll be showing you how to look at this stuff more closely. But I'm just trying to give you an overview here. I'm going to look at gross and net profit margin. This company maintains pretty good profit margins for a low margin industry that it's in. I'd like to look at things like, returns on assets, returns on equity, returns on invested capital, and see how these things are faring, historically. I'm just going to go take the company through the whole thing. One of the real important ones that I like to look at when I'm going through this is I like to look at common shares outstanding, okay, because I want to see if the company's been buying back stock. Now, they've been maintaining their share count, maybe a few shares they bought, which to me is more corporate work, not really reporting shareholders, because this is when the stock price, if you recall, was very, very high. So I don't like to see companies doing that, buying back stock, but they're maintaining the share count currently. Now, I've gone through a whole lot here with you, and there's a lot more that I should and could go through with you. But the reality of the situation is I wanted you to see that valuation matters, and it matters a lot. When you see overvaluation, it takes just a simple catalyst like the earnings report that the company just And by the way, I will go in and read the earnings transcript. That's another part of the research process I will do. But that obviously the stock got ahead of itself. The fast graph clearly showed this excessive valuation. We've had a cleansing up to now, no pun intended, or maybe a pun was intended. But I don't think we're sterile enough yet. I think the price is still kind of high. And I do believe we've got a year coming up that we might want to be paying attention to this stock if we owned it. And I'm not sure I'd be willing to buy it today. But anyway, this has been a deeper dive into Clorox Company, a stock that I really would love to write about or blog about or make videos about if I could buy it at an attractive value, because this is a dividend aristocrat and dividend champion with 44 consecutive years of dividend increases. And they've done that. They've grown the dividend just in the last 20 years at over 9% a year. Terrific company to buy if you can buy it when it was reasonably priced. And this is where I'd have been really interested in Clorox. I'm still not really that interested yet. Hope you enjoyed this video. I hope it gave you some insights into a lot of things: valuation, how to research a stock, how to analyze a stock, how quickly information can change, and how you have to stay on top of your holdings. These are all messages that I wanted to get across today. I hope you enjoyed this. I appreciate you all. If you liked the video, give me a like, ring the bell. If you haven't already done so, subscribe to the channel. Look forward to talking to you again real soon. Thanks for watching.